The first thing that I would do when I mean, obviously in FX, we're constantly running. We're constantly being fed information and watching the price action throughout the course of the day. But what's important to me is I would check to see what's going on in a fundamental perspective, just to get an understanding, just to get a feel for, like, a bit of a tone for what's happening in the week ahead. So I would look at the economic calendar, and first we can have a look here at the economic calendar. This is the one on forexnews.com. And what you do is, on forexnews.com, what you can do is you can just go and just create just go to Join Forex News, and then they'll email you twice daily. They'll email you just fundamental updates. And the nice thing is, especially when you're just getting acquainted with this, is that they will tell you which ones are important and which ones are not, because the economic calendar can be quite extensive. So they will tell you which ones the market is more or less viewing as more important, more impactful than others, and those ones are the potential market movers for that week. I mean, you can have a list of what are labeled as market moving economic reports or data releases, but they won't necessarily always move the market. Yet something else that is not on the schedule may move the market significantly. So if you scroll through this here, there's nothing really in here that's going to indicate to you which ones are the more profound ones that are coming up in the week, which is why it's important to maybe just scan through the article so that they'll sort of notify you as to what's important that week. For example, this week we have, just at a glance here, we have Eurozone manufacturing PMI will be important. Canada retail sales, I'll be watching that one because I'm watching the Canadian dollar right now pretty closely. I'm kind of stalking it, looking for an entry, and we may even be at an entry point now, a bit of a higher risk entry point. But stalking Canadian dollar, so I'll watch Canada's retail sales. We have in Japan, they have trade balance, because I'm watching yen also, the yen in the carry trade scenario. So trade balance will be an interesting one. Australia, this one is very important because I'm trading a lot of Aussie yen, and Australia has Q2 CPI coming up. That will be very important. Why would Q2 CPI be important? Anyone?
If it's up, it'll strengthen the Australian dollar.
Pardon me?
If the CPI is up, I assume that it could trigger thoughts about raising interest rates.
That's correct.
Which would strengthen.
Correct. So if CPI is up, then the market processes that information and potentially could start to price in anticipation of further rate hikes in Australia. So then the Aussie dollar will rally as a consequence. Okay? And then we have in the U.S. we have Q2 GDP year over year and University of Michigan sentiment survey. And there's one I'm missing here. Oh, Reserve Bank of New Zealand, and it's not listed in here, is also up this week. And also Minister of Finance Cullen, who I mentioned yesterday, he has also been trying to bone down the currency a little bit, but they are anticipating the possibility of further rate hikes in New Zealand, which could really prop up that currency. So, for example, if the market is thinking that we could see further rate hikes, I wouldn't be selling into that into that scenario. In fact, I'd be looking for buying opportunities. Okay, I'd be looking for pullbacks or buying opportunities. So that's just a quick scan. There's another pretty good economic calendar that I think that you might find very, very helpful. This one is very good. And I can give you the link for it later because it's really hard to find. But this one's done by Econoday. Are any of you familiar with the Econoday economic calendars? The nice thing about the Econoday economic calendars is it's a real resource center to help you to understand what the various economic reports mean. So, for example, this week we have in the U.S., here's your economic calendar. Here we have a list, and there's all kinds of resources in here. But let's say they show the market moving indicators, so the market moving data releases. They have a star next to the ones that are market movers. So if you want to know what that means, so for example, GDP, if you want to know what that means, you simply click on the link and it will explain to you what it is, why the market cares about this particular data release, and it gets into some detail as to what it's about, some data on its history and so forth. But to start with, you may just want to get a basic understanding of what they mean and why the market cares. So it's a real nice resource center. Okay? And but the problem with that calendar as FX traders is it's typically only U.S. It has some of the major international releases on there, but it's mainly only U.S. Now, going back to Forex News. They will, twice daily, they'll release, just like a report of what's going on generally in the market. And here the title on this one is Yen Climbs Higher. And this one's a little bit delayed because it's actually giving back already. And anyway, in any event, it just gives you a bit of a summary as to what has happened and what to anticipate. Let me see if this one talks about what's to anticipate this week. Yeah, it says greenback kicks off trading mired near its lows as traders posture. Several key economic reports due out this week. So they're basically giving you an idea as to what to expect this week out of the FX markets from a fundamental perspective. Giving the increased scrutiny over recent data for spillover effects from the subprime meltdown. Traders will carefully analyze housing reports, Q2 GDP, PCE, and University of Michigan Consumer Sentiment Survey. So here's what they're telling you. What they're saying is that, recently we've had aggressive trends against the U.S. dollar. Okay? And it's largely fueled by fears over subprime. Okay? Now, when the market carries that kind of sentiment, whether it's warranted or not, whether you think it's warranted or not, remember as a trader you have to be very careful about having your own opinion. Just look at this information objectively. Whether you feel it's warranted or not, just don't get in the way until you start to see some technical aspects that are looking that it's wanting to maybe start to move in the other direction. Right? And there are some scenarios unfolding around that where you can be tempted to go long the U.S. dollar, but you want to be very, very careful in such a strong sentiment environment that's, whether they're using the subprime meltdown as an excuse, who knows? We don't know. I mean, we don't know. It's just, but don't get in the way or don't really try to trade against these trends, against that type of sentiment. Okay. Now, it goes further on to say how sentiment over global interest rate differentials will continue to be a key driver in FX movements. Okay? That's what they're telling you. And that's what the sentiment is within this particular institution. But you'll find that consistent among, a number of the institutions. So, where are you looking for trades then? Where are we looking for opportunities? Interest rate differentials are listed here as a key factor, and when we look at the charts, it's very, very obvious that the high-yielding currencies with a high overnight rate, are the ones that are really trending right now. Okay? For example, on this page, we have a list here. It says short-term interest rates, and it gives you a list of what the overnight rate is for the various regions: U.S., Japan, Euro, UK, Swiss, Aussie, and Canada. And the only one missing there is New Zealand that I'd like to see in there. But It's at 8, which is the highest of them all. So it gives you an idea of what the interest rate differentials are. And yesterday I talked a little bit about what some of the leading factors are on getting a feel for which way interest rate differentials are doing. There's basically two simple ways that you can get a feel for the interest rate spreads. And what would those two be to get a feel for how the interest rates are spreading from one region to another? Any ideas? So number one would be if you watch the bonds prices in the various regions. That's a little bit more complicated and probably not really necessary. Okay? If you can keep an eye on that, great. If not, you're better off just listening to the tone and the sentiment and the verbiage that's coming out of the central banks. So the central banks will release information regularly, and we'll get a tone from even just listening to Bloomberg. Even just listening to Bloomberg, they'll talk about the interest rate spreads driving the FX markets. So you want to be, then obviously when you look at the charts, you'll see that the trends are significantly fueled by the interest rate differentials and perceived spreads that will occur in the future. So, for example, as we talked about earlier, in Australia, they have a data release coming, and the market could anticipate further interest rate rises, and that will all be sent to you in a news format or a summary from perhaps Forex News if you subscribe to the free summaries. Moving further down, so it says sentiment over global interest rate differentials will continue to be a key driver in the FX movements. In light of last week's congressional testimony from Fed Chairman Bernanke, the FOMC remains poised to leave policy unchanged with a bias against inflation. What that tells me is that the market is viewing the U.S. as the interest rates are not going to be changed there. So therefore, if in Australia there's a perception that interest rates will hike, what will happen to Australian dollar versus U.S. dollar? It will most likely continue to rally. Okay? Those little things, and you want to go with the flow of funds. That's what's driving the trends. That's what's driving the flow of funds, and you want to. Then you look for your technical setups in those currencies, and believe me, I think just on this premise alone, you can move, and I do it all the time personally. Is when I see these trends moving, I will move funds from one currency to another. I'm not trading across or anything effectively. I'm just making a spot exchange from having my assets in one currency, moving them to another. And there's a lot of different ways that can be done, but just to give you the idea, that's where the funds will flow. So, for example, if you're a corporation or a hedge fund who holds a lot of cash, because hedge funds, of course, have a percentage of their portfolio in cash, they will move them from one currency to another, and usually, because they want liquidity with this cash, they'll usually move them to currencies with a high overnight rate. On tens of millions or hundreds of millions of dollars, a substantial difference in the overnight rate can make a big difference. Okay, so that's how I would kind of start things out, just to keep a feel. It really does not take long to just go through this and bullet point it. Alternatively, you could have what we got here. Alternatively, you could get a bank report that would look like this, and like the ones we saw yesterday. And what they'll do is they'll bullet point it for you. This is a UBS one, and they just bullet point it for you. U.S. dollar down on subprime woes. Reserve Bank of New Zealand they have a rate announcement this week, and Australia's CPI. So we're watching it. Eurozone has business confidence and sentiment surveys due. It's called the IFO, is what it's called. And then that's about it. That's what they have as their key bullet points. They don't have the US GDP in there. And then they just will explain it in a little bit of detail here. And they talk a little bit about Japan, but the one thing with Japan is they have an election coming up later this month. And I think that there could be some jitters in the market in and around the election, maybe a little bit of volatility. Again, warranted or not, who knows? What's going to happen with price, but I would have a little bit of hesitation or acknowledgement of the fact that there is this election coming up later this month, and there are some, like any political environment, there are some issues in and around the election and some concerns. So you may just see a little bit of a jiggle as a result of some concerns around that. Okay. And so just, once you get into a routine, it becomes fairly, fairly straightforward. It really doesn't take long at all. Any questions on that particular aspect of it? No? Okay. All right, so let's look at some price action now, which is, most important. Yesterday, let's just walk through price action from Friday up until yesterday. There was, on the economic calendar, there was really nothing of any substance. Yes, today, which is, when I say today, I mean starting in Asia yesterday, which was Sunday. Today or tomorrow, effectively. And except the U.S. subprime lows, which basically nobody's standing in front of and interested in buying U.S. dollars for whatever reason, again, warranted or not. Now, we had on Friday, I was looking for a potential failure at this high here. But again, these trends are so strong that you want to be very, very careful trading against these trends for reasons that we just covered. And price bounced a little bit at the high because this is the British pound US dollar, and I like the volatility, but there was a data event that came out on Friday which basically was, again, relatively positive for the UK. So you have a positive data release against a weak US dollar sentiment, and you really don't want to stand in front of it. Price moved through the high, but I just want to show you what happened to price. So there was no trade there. I was looking for a trade, either a failure at the high or on the long side. The trade I was looking for was down here. So our price was, let me clean some of this up here for you and walk through it step by step. Okay, we're moving into Friday's price action. And we had a data release in the UK, I think it was GDP. It was GDP in the UK on Friday, and I anticipated that if price pulls back down to either this level here, the 50% retracement and the 127% extension, not interested in trading there as much as I am either here at the 62% retracement, 162% extension, or this 79 and this level of resistance becomes support. Those are of more interest to me. Again, we're buying on pullbacks in an uptrend. So I was looking at buying either here, pullback to there, or a pullback to down here. Okay? One of these areas I was looking for a bounce and for the trend to continue. Because if the price moved down, the reason why partially is because if price moves down there, not all the bulls are totally convinced that this trend is over, obviously. They're not going to change their mind like that and just start to liquidate positions just yet. There's too much strength behind this trend to get a major collapse in price. And also, it is a logical place where price can pull back to, and then we can get, you probably would initially get a bounce on the day, and then you'd have to wait until the next day or the following day for the trend to continue if that bounce is to hold. But you likely would get a bounce, particularly at, you see this level of resistance here? it is also, that level of resistance is also right at 204, the figure. And I would think that as the trend continues to move up, we haven't seen 204 in several days, and as the trend continues to move up here, knockout options can start to accumulate at that level, and it could be sensitive, what I call a sensitive level. But what happened was the GDP came out at 3.0 versus 2.9 expected, so the market rallied. Now when I would see this data come out, then I definitely would not want to stand in front of it, okay, because the data was positive. So that now eliminates the possibility of trading short against that data release. At that point, it's like, you know what? Subprime sentiment, whatever, or along with the GDP, there's only 1 point, more than expected, but still you don't want to stand in front of it. So then takes out the short trade. Price didn't pull back, there's no long trade, and then price just, it worked its way through the highs, and then just to show you the market characteristic, you see how the dealers moved price above the highs, and then how that level became their reference level at the base of the dealing as they moved into the weekend. Consistent with what we talked about. They moved price up through the highs. Wasn't much follow through, but it was strong enough that if this was really weak, the dealers would have taken this back down. It wouldn't have been supported here at these highs. It would have come back down here and started dealing below that level, which would make the currency somewhat weaker as it moves back into this recent range. Does that make sense? All right. And then now moving into today's price action, the market, let's just take this one out of the way here. Moving back into today's price action, this is what we saw yesterday during Asia. And what did I say about Asia price action during the Asian session? Relative to the previous day's range, or the intraday range?
Making higher lows.
They typically do not move price beyond the previous day's range. About 3 days a month, roughly, by our studies. So this is the previous range from this, from this high. I can't see very well from there, but from that high to this low, it's a previous range. Well, still quite bullish. And what happens is so price came up, sniffed at the high, but did not get through during Asia. Just not enough volume, not enough follow through, and which is a fairly common price action. However, if I do get this during Asia, sometimes I'm interested in a short, very high, kind of a high risk trade, and sometimes I'm interested in a short. But this one was a pretty dead bounce. I mean, I wasn't on my computer at the time either, really, or watching it that closely. But it was a really, really soft bounce, especially for the pound. The pound can pull off those highs quite generously during a regular Asian session. But the whole Sunday, Mondays and Fridays are lower probability trading events and trading days in any event. The volatility is different than it is on Tuesday, Wednesday, Thursday. So it pulls back slightly, and then where does it go? This is a trade, a high-risk trade that I would take. Price goes to where?
The figure.
It goes right to the figure. If you look at your charts and just scroll through your charts back, when the market, note I want to make on the figure is this, is that the market hasn't seen this price in a long, long, long time. And but when the market has not seen the figure in, let's say, a couple of weeks or several months or multi-years, typically the figure is a sensitive dealing level. And the fact that this is, again, price is just pulling higher on the in the basic fundamental foundation that we've mentioned, and there's not necessarily a real additional rationale for the continued price movement up, except what we've talked about. And here at 206, typically the figure is quite a sensitive level. And And here we get a bounce. We get a bounce of, we got a bounce of, I think, about almost 50 pips or, this is very common. So we went from 206 to around, we got about a 35 pip bounce there. 35 pip bounce. Very, very common, this, if you look back in your charts. And it's you know, it is definitely a sensitive dealing level, especially if it hasn't been seen in a while. But really, then the market just basically consolidates because there's nothing of any substance, no short-term economic drivers forthcoming. And this is very interesting. You see how price comes back up to the intraday range to 206 and bounces again? I want to say something about that, and that is quite often what I will do is, if price rallies, remember how I talked yesterday about having that volume battery full, and then as Asia opens and drains a little bit of the battery, and then as Europe opens, we see volume get pumped into the market, and then New York opens and more volume gets pumped into the market, all the time driving volatility throughout the day. This is a very, very low volatile day, very, very small, pretty tight range, because it's a Monday, and there's nothing driving it. So what I would do, however, is if I saw price come up and make like an intraday high, say that this was maybe a swing high and an overall larger downtrend. Price comes up, makes a high, then if you have a lot of volatility throughout the day, and then price comes all the way back up to that intraday high again, I would sell it, especially if this was in a downtrend. Definitely would sell it, because as we talked about yesterday, the market is typically, when the market has established an intraday high or low, and then there's been a lot of volatility and uncertainty throughout the day, then toward the end of the day, if it goes up and tries and moves toward that level, I will trade against that move, anticipating that price will come back into what? Into its range, okay? Because the market spends 80% of its time in a range. In any event, this is a very, very minor example of that. Not a tradable, very minor example of it. Okay, and that's where we are now. Again, just waiting on some economic data. The pound continues to move up while the euro is looking weak.
Could a question on that chart?
Yeah.
Why is the 2.0500 not necessarily a threshold level like the 600 is?
Right now, would you say?
No, looking back in the past, you don't see, it's fairly common knowledge, I guess, that the even numbers like that, or like the 500, 200, 500, 400s are like magnets. In a sense, but that particular 500 does not seem to have any...
Yeah, I'm trying to remember what happened at 205 here. Let's find 205. 205 is right here. Sometimes what happens is, in this case, it drove right through it, but sometimes it just depends on what the fundamental driver is at the time.
Oh, okay.
And but yeah, sometimes it'll just plow right through it.
So if it smears right through it on the first shot, does that sort of eliminate any particular significance at a later time, like you should?
Yeah, good question. The figure is more sensitive if price has not touched that figure in quite a while. And the longer the time period between price touching that number and current time, the better. Now, but if price has moved through it quite a bit in recent price action, it basically dissolves that effect. Pretty much dissolves the value in that technical balance.
Okay.
Yeah. Because you'll see quite often, as we see here at 204, for example, you see this high right here at 204.
Yes.
That's a very distinguished swing level. Quite often you just get a bounce, it comes back 30, 40, 50 pips, then goes through it. But this is a very distinct swing level. Intraday swing level, so at some future date we could see some sensitivity. Just a standard support resistance figure type sensitivity. Yeah, good question. And so here, the reason I like it on this pullback is that it lines up relatively well with that 62%. Sometimes what I'll do is if price is approaching the figure, and it looks like, or if it plows right through, then 20 is the next level that you're likely to see some sensitivity. 20 or 80 on the downside. Okay. What I don't like right now is the pound is rallying, but the euro is really struggling right now. And so there's some incongruencies with the US dollar crosses there, and also the Swiss franc is falling. Let me just show you the euro quickly. So on the euro we had let's just get rid of that. Everything's kind of useless. Give it some space. So the euro actually pulled back today, and these charts are not set up at the moment, but so the euro is pulling back. The U.S. dollar has rallied a little bit against the euro, yet it's fallen against the pound. And in that type of environment, I just call that a low probability trading environment. I like to see some consistencies or some patterns and some nice flow among the two. And in that case, I like to just stay away from the U.S. dollar crosses, typically. You know, these things sneak up on you. And the market will move into a nice flow and out of a nice flow, and that probability continuum is really sneaky. And it's you know, you have to be very, very sensitive in picking these things up just by slight deviations in price action from 1 hour to the next to 1 day to the next. And for me to start to be interested in this pair, I would like to see. Right now, it's actually in a bit of a buy area, but I'd like to see price move below this 3,800 level, and then also start to see the pound show signs of reversal. Right? Here we see that price has made several attempts at the high and has failed to get through. Let's move that to a smaller time frame so we can see it on maybe a 4-hour time frame. Let's go 4-hour time frame. So we see the 4-hour time frame, and the market has just basically been consolidating, and it's still somewhat bullish, but we now start to, because we're seeing some very discrete higher highs and higher lows, and if price starts to pull back a bit, then we can start looking for some potential shorts.
Do you find that as the time frame gets larger, the significant numbers have less significance?
No, I think they're the same. They're the same regardless.
Okay.
Yeah.
Chris, in a case like this, would you be, how to explain it, would you be more likely to wait for the trend to reassert itself and take a long, as opposed to try to play the reversal to the other side?
Yes, I'd be watching the underlying fundamentals. And usually what happens, on the fundamental perspective, usually what happens is this, is the market will take price one way or the other, and then afterwards they will rationalize it after the fact, and they'll say, well, the reason why the market moved today was because it's one of those cases of after the fact fundamentals. So then they'll say, okay, the reason why the market did this is because of such and such, and then the market will, potentially come to believe that. And if they start to believe it, then that can become the sentiment for the next phase or the next cycles of price action. Okay. Does that make sense to you? It's just that fickle market, and those are some of the little things that I'll look for. Is some of the after the fact sentiment and so forth. Okay. Let me just go through some yen crosses. I want to show you what happened with yen on Friday. We had a yen rally, as you saw in that in the Forex, in some of the articles we talked about yen rallies. And I've been very much participating in short yen trades because of the environment and because of the interest rate environment, of course. And what happened was, and I missed this one, I've been waiting for it, but I missed it, is let's tie in some of the things that we talked about yesterday. The reason this chart looks quite compressed is because the trend has been so strong here. And you can see here the recent low is down close to 220, and now we're up at around 250. And let me show you what happened in recent price on Friday. So on Friday, our most recent swing low is here, and then we follow the rallies, but we saw price do several things here. First of all, the price opened here at 250, just above 250. It rallied above the highs, and then the rally did not hold. So they took price back below the highs. Then, so the intraday high became 251.10, right? So from 251.10, if the average range for this currency is, let's say, 150 pips, then once range starts to get stretched on this currency, that's, let's say, 200, 250 pips, then I'd start looking for an ideal level of support, because we're in a substantial uptrend here. I'd look for an ideal level of support to buy this currency, because although the yen crosses can drain very fast, you can see the unwinds occur very aggressively, and they can move 300-400 pips in a day, this particular cross. That's obviously, has to be considered. But price came right down to this level of resistance, becomes support, and 38%, the 0.3 to 3.2. Right? Then we saw a very quick reaction, actually 150 pip reaction right off of that level. And so that price on that particular day moved from a high of 251.10 to a low of 248.59. And so 250 pip move.
You mentioned that you missed that. Could you explain how?
I didn't see, I was busy, and I wasn't at my computer, and so I missed the whole thing. Otherwise, once I saw that high rejected, I would have started to watch. I would have thought maybe it's just coming back into its range, but then once there was some aggressive yen buying, and if you look at the yen crosses, the same thing was happening, exactly the same thing was happening on all yen crosses. So if you look at the yen cross, we saw the exact same thing. So it was a yen-based move. It wasn't necessarily specific to New Zealand dollar, Aussie dollar, pound, euro, all that are moving well against the yen. It was a yen move. Okay? And regardless of interest rate differentials, it was all about yen buying. And so the price came right down to that technical level. It maxed out in its range, and it was at that same technical level on the other crosses as well. It was just a classic, nice pullback. It's actually the kind of pullbacks that we like to wait for. The fundamentals are so strong on that currency pair, on the yen crosses right now, that when you get a dramatic pullback like that, it's a great opportunity to get in. And you hear all this stuff on the news. Now you hear it, every week you're hearing on the Bloombergs, and not so much CNBC, because the Americans don't, it's not, the Americans from a consumer perspective or from a retail interest perspective, the Americans aren't as interested in the yen carry trade as are Asians and Europeans and fund managers. So you don't hear a lot about it because it's not necessarily as newsworthy as other things on American television. But in Bloomberg, you'll hear it talked about a lot. And there is a lot of media in and around the carry trade now. And the big story is when, if, and how is it going to unwind? So the unwind is a big story. But like any bull market, okay, once I stayed out of a market thinking it's going to crash, it's going to crash, it's going to crash. I missed so much opportunity thinking it's going to crash that I won't do that again. All I'll do is I'll participate in the trend in the best way that I know how, manage prudently so that if it does unwind, if, when, and how it does unwind, because they do, protect you just need to be protected, that's all. I got hurt so bad being out of, one of the best trends that I'm like, that's it. Because once your aptitude for trading expands to a level where you can, prudently manage your positions in aggressive bull trends, then there shouldn't be anything you should be afraid of. And so that's my underlying, I'm covering the concerns on one hand, yet I'm participating using my knowledge on the other hand. Because this unwind could occur, and the election's coming up later this month. Who knows, if, when, and how it's going to get triggered. The election's coming up this month, but then typically a lot of the yen unwinds have occurred in the first quarter of the year because Japan's year end is March, the end of March. Right? So this one immediately pulled back about 150 pips off of that level. And remember, you're getting rollover interest on these trades. Depending on how you're set up, the interest is paid in different ways. So let's have a look at the Aussie. Is this a smaller? Okay, here it is. Let me show you this. This is the same currency pair on a smaller time frame. Okay, this is what happened. Price moved up, it consolidated, prices moved up, formed a high at 251.10 here. Then we saw the yen rally, but on this last swing, we came right down to the 79% retracement, and the last level of resistance becomes support. I love this stuff. I do. And I had talked yesterday, I made a little comment when Mark was speaking the other day, and I said, quite often we'll get an aggressive move between the 618 and the 786. Once it slips through 618, we'll get a slip through to 786, and that's exactly what happened here. And by the way that I enter trades, I'll stand in front of that move. Sometimes what I'll do is I'll stand in front of it with a little bit of a position, and then maybe I'll wait to see what happens, and then maybe I'll add to the position a little bit. If I see a bounce and some confirmation that it's holding, then I'll be somewhat willing to add. And sometimes this thing may start to move off that level so aggressively that it doesn't give you another chance to add. And then what I'll do is maybe I'll take a little bit out and then hope that it comes back down again. You just never know. So this was interesting though, because I was so price came down and then rallied 150 pips, and then moved off. If you look at this downswing, price came down, moved up to the 62% retracement level, then fell all the way back. Okay, and that's yesterday. I think I was sitting next to Rodney there, and I said, "Look where it's bouncing, but I wouldn't sell it there. I wouldn't sell at that 62% retracement. Why? The fundamentals are way too strong. You want to be looking for buying opportunities, right?" And so this has held, and we're still bullish at the moment. So that's a shorter term perspective of what has been happening on that one. And then so looking at the Aussie yen, and this one, we trade quite a lot. And here is this is the 1 hour chart. The unwind came down, and let me show you the larger one first. Otherwise, if you don't see the larger one first, it can be confusing if you don't see the daily chart first. Here's the daily chart. Price came right back down to resistance becomes support. I realize that these candles are very small, but they're very small because of that trend. And it came down, resistance becomes support, down to the 382. Does it look a little bit like that pound yen? Does it look like the pound yen? It looks exactly like the pound yen. Okay? Resistance becomes support at the 38%, and look at the move off of that level. So price doesn't look like much of a move, but let's have a look. The low is 106.02, and now it's at, it's gone up to 107.30. Okay? So 130 pips off of that low, with the anticipation that this trend will continue. This is why I like to trade this way. I love these trades. They make life easier. The shorter term trades are a little tougher. But to catch this move, you'd have to be watching the market or have your alarms, knowing that this yen rally is underway. New Zealand yen, before I jump forward, let's just go to the Aussie yen on a smaller time frame. This is really cool. Watch this. The yen rallied, so price fell here. Aussie yen fell. Then on this downswing, as it's falling, price came right back up to the 62% retracement level and bounced. And this is me last night. I was watching this because this happened late yesterday as we were kind of closing up shop. And then I went back to my room and I was looking at this, because that's just the way we are. We're addicted to this stuff and we just can't get away from it. And then I was watching this thing come right down. You see this price swing here from this low to this high. As price was coming down, it came right down to the, what level is this?
79.
79 retracement level. And I have a client who trades this almost exclusively, and we were talking about this pair, and I said I don't really like the time of day, that this is occurring, but we probably won't, because of the time of day, very unlikely we'll get through the lows here. I'd like to see it make a run at the low, but it could hold here. If this holds, then we kind of missed the trade. But this was very interesting because when this happened, let me just move this over a bit for you. Sometimes I just like to watch price just to sort of see how it's behaving. And as let's get this line out of the way. After price, let's just walk through this. After price bounced here at the 786 and started to move up, where's our next battleground?
Next what?
Kind of battleground for price, where we anticipate price will bounce.
Where you got the black line.
Wherever that black line is, because the market just had a short term. There was a short term dealing support level, and price came right back up and bounced right at that level. And because what happens during Asia typically is that when you get this kind of volatility during Asia, usually it'll just end up consolidating, going into like just a consolidative mode.
What times of day here is that occurring?
This is during Asian session, because this is the Aussie yen pair. So you're going to see some volatility on the Aussie yen pair during the Asia, Australia, New Zealand session.
So that's early, late evening.
Yeah, for us, it's like, 5, this time of day, it's like 5, 6 o'clock, 7 o'clock. Okay. And then, and then it just consolidated from there until today. It just continued to move back up. These trends, looks like they're kicking back in. Okay. But do you see the relationships there? And there are times where you'll need to just step away from these crosses, and usually the end of your term, the end of my term with a currency cross is usually ended by a loss or two, and then the market just goes into a bit of a low probability trading environment. So I'll be participating, and then if I take a couple of losses and I sense that the volatility has changed somewhat, then I'll just step away. This is the New Zealand yen pair, and we talked about the fundamental aspects earlier today, and it's driving price. You see how the other yen crosses have not been making new highs, while the New Zealand right now is just making a new high. It's a result of the underlying fundamental aspects that we talked about earlier. And it's not rocket science, and you don't have to be an economist. You just have to be able to listen, digest, filter, and discern,
Are you better off not being an economist?
Probably better off not being an economist. Okay? But I guess what I want to help you to understand is, do you see how everything is working together? These are, any time that you get a big pullback like this, or like this, or like this, and we had that minor one, people get very scared, because although these trends are very, nice and friendly and very strong, when these suckers decide to unwind like this, it can lay an absolute whooping on you if you're not using good, using stops properly and so forth. If you're not careful, because these yen crosses can do that.
Chris, I'm looking at this move, and we've got the heavy black candle, and then the one that almost looks like a doji before it, the one right there. Yeah.
Here?
So now the big black one, I'm just eyeballing it, looks like it might be 79% of it move up.
Yeah, I can't remember. I think it was, actually. Looks about 79. Just below. But they're on that down move. Again, on that down move, if you look at the other yen crosses, they came to real sharp technical levels.
So that's my question. Would you be, assuming that the fundamentals were lined up, would you be thinking, if you weren't in, about probing for a long position here?
Oh, definitely. In fact, we did get long, mostly Aussie yen and pound yen, but I'm not a big trend line guy, to be honest with you. I'll use trend lines on larger time frames. Trend lines are handy to just give you a nice graphical squaring of the picture, of the technical picture. But on the longer time frames, this one here, we had this trend line, and what I like here is I like this level of, this level right here. And I like 79 retracements, especially in reversals, or in really aggressive moves. Because quite often, if you see an aggressive spike running toward a low or a high, it would go to the 79 retracement level.
So assuming you did take that trade, how long would you, when you talk about long-term, short-term trades, how long would you be in that trade?
Well, what we do is we've been trading this for quite some time, like a year and a half. We've been playing with these trades, but We do a number of positions. We do like some exotic forwards, we do some options, and we do spot positions. So, but they're all, the strategies are, depending on the portfolio, they're all either, correlated or non-correlated. But, so let's say we're just trading spot, because that's what would interest you. If we're just trading spot, what we do is this, is even when this thing pulls back, we'll immediately start to take some profit out on the spike up, because we don't know that's not going to continue going down. So we'll immediately try to fund our position, or finance our position, as you would call it. As to say, fund the position. So we want to get ourselves in a position where we're holding, where we protected the position. We give the market, we give these trades a lot of room to breathe, by the way. We're not talking 20, 30 pip stop. We're talking like breathing room. So we immediately try to take some out, fund the trade, and then we sit on a certain position size. Again, because your risk is based on your total exposure, right? Your risk is always calculated based on total exposure in that marketplace. So we try to get some out, and then we just hope that with what's in there, whether it's 40% or 50% or whatever, maybe even 20%, then we just hope that it continues on, and then we'll maybe scale out a little more. But in these trends, we always will have something still in there, because you just don't know what it's going to do. It could just keep going, and sure, it's painful if you've only got a small position that's still in there and it keeps going. You want it to pull back at some stage, and it's painful to see where, because the problem with developing traders is they just think that they're going to put lump sum in and then lump sum out, and it doesn't work that way. You have to slowly build your equity through prudent position management, and just build your equity over time. And then as the equity builds, then you can start taking larger position sizes. Okay. Is Mark waiting on me over there? Or is he okay? Okay. Does that make sense? You see, Mark, let me know when you're when you're ready.
Well, whatever you're...
Because if you got some price action happen, let me know.
I think I probably do, but...
Okay.
But, don't interrupt yourself.
No, I'm cool. You see, the thing, and this is a good example, is that traders always want to leave the trading table with their stomach full. And if that's your objective at the end of the day, then you're going to hurt more than have a full stomach. Okay? You should feel satisfied at the end of a trading day based on the fact that you have made good entries, managed your positions well, whether they were winners or losers, that you managed your positions well, you either saved from substantial losses, or you made some money through good position management. That's what should be, is what should give you contentment at the end of the day. If you're trying to fill your tummy, then you're going to be waiting a long time, and you're going to be taking a lot of big hits, trying to leave that big satisfied 200 pip day, and you're happy. Those will be few and far between, but when you just manage your positions properly, take out the equity when the market makes it available, control your risk, and then leave some in there in case the trend keeps going, which you don't ever really know if it's going to do that or not. Right? So that's a little side lecture there for you. I go in a lot more detail on that one, but okay. I can cover like Canadian crosses and stuff later, but if you want to, if you're
Might as well see what's happening.
You want to get at her? By the way, this one, let's just, we'll just have one quick look at the Canadian dollar. I'll just look, because I've been looking to buy it.
It's a second row.
I'm looking for that. Oh, there's a 60-minute there, yeah. Okay. Yeah, that little bugger. It's moving already. I said to Rodney yesterday, it comes down here to 62, buy it, but it actually collapsed into, in Asia, it came down here to 79, but it's reversing right now, and never mind all this stuff right now, but it's reversing, and I think that it's forming a base, and that was a good buy level, and it just took off. See, it's taken off, not quite enough that you can get your first profit out just yet, but should get it pretty soon. Anyway, We'll talk about that later. We'll let Mark?
Yeah.
What?
Sure, I'm just...
Well, he's getting ready. Do you guys have any questions? We need questions.
I want to hear more about your money management technique.
Yeah? You want me to shake my finger at you?
You said build slowly and then make larger plays.
Well, I mean,
How you address that in your trade?
we use a lot of different epi management profiles depending on client or the type of strategies that we're employing with that client, and depends on instruments as well, But let's just assuming we're just trading spot. If we're just trading spot, one thing that we'll do, for example, in a program that we had previously where we were managing funds for clients, is what we did was when I was managing with that partner who I'd spoken of, we would start the account assuming that your first 10 trades are going to be losses. So based on that assumption, that's the starting point. That your first 10 trades will be losses. How much will you lose on this account if your first 10 trades are losses? And then we would aim to build the account by a certain percentage, say 5%. We would aim to build the account to a profit of 5%. Once it's at 5%, then we place a gearing. So we place a very low gearing on the account up to 5%. And then, like fractional gearing. And then we would...
I don't know what gearing is.
So let's say you have $100,000 in the account, you only trade, your exposure would be on, say your position size would be, let's say if you're using 0.75, what would that be? $75,000. $75,000 would be the, how like a lot size is $100,000? Well, lot size, if we have $100,000 in the account, we actually have a position size of, say, $75,000. So it's unleveraged, or it's fractionally geared, okay, to 0.75. Whereas most people go the other way, they'll do 10 to 1 and they'll trade $1 million on a $100,000 account size. A lot of people will do that, right? So then we'll build the base of the account up to, say, 5%, and then we'll place a gearing on the base and then gearing on the profit portion. But then you can also have a portfolio and diversify a little bit where you take 10% of the portfolio and you ramp up the gearing on it. So things like that. But in terms of position management, we can talk about that, let's say,